Welcome to your end-of-day market explainer for August 7th, 2026. Look, if you're sick of the usual financial media fluff and you just want the precise, actionable data to actually navigate the tape, you are exactly in the right place. We're skipping the talking heads, we're ditching the financial astrology, and we are diving straight into the numbers, the catalysts, and the real market drivers. So grab a coffee, sit back, and let's decode exactly what happened on Delau Street today so you're locked and loaded for tomorrow's opening bell.
All right, let's look at this closing snapshot. Markets actually managed to close higher today in what was frankly a really choppy weekly expiry session. The Nifty squeezed out a modest gain, closing up at exactly 24,636. The Sensex, though, it showed a lot more muscle today, closing up nearly 0.5%. We're rounding that off to a solid 78,955. And you know, it's absolutely crucial to look past the decimals and focus on these broader psychological levels. Despite the intraday dip buying and some selling pressure, we're looking at a market that broadly just secured its second straight weekly gain. Not too shabby, right?
So what was actually pulling the strings beneath those headline index numbers? Well, the gains were heavily anchored by the heavyweights. We're talking Reliance and the broader banking sector. Both PSU and private lenders really stepped up to the plate today. Bank Nifty held its ground beautifully, closing right near the 58,060 mark. On the flip side, though, we definitely saw some lagging in Realty, auto, metal, and IT. But here's the fascinating part. That sharp divergence between the Nifty and Sensex we just talked about, a massive chunk of that was driven by the new closing auction session dynamics clashing with the weekly derivatives expiry. It created this wild temporary dislocation, and algorithmic traders were absolutely feasting on it right into the final bell.
Okay, but let's talk about the real macro catalyst today. The absolute elephant in the room. The RBI just dropped a regulatory hammer on the NBFC space. They floated these incredibly strict new draft rules that basically restrict shadow banks from offering certain revolving credit and flexi loan facilities. Now, guys, this isn't just a gentle slap on the wrist. This is a foundational, structural change to how these companies operate their absolute highest margin credit products. And you know how this goes. The market despises uncertainty, and regulatory overhang is pretty much the ultimate uncertainty. If you're holding financials, this is a structural shift you literally cannot ignore.
And here's the immediate fallout, which is just brutal. The news instantly hammered the lending complex. I mean, we saw BAJFINANCE crater by nearly 6%. To put that into perspective for you, that single move wiped out roughly 33,500 crore from BAJFINANCE's market cap in just hours. Poof, gone. Why the sheer panic? Well, the analyst over at IIFL flagged that these revolving flexi products make up roughly 15% of their total assets under management. That is a massive chunk of their most profitable book. Cholamandalarm dropped 3.8%, and Bajaj Finserv was right behind them, down 3.7%. We've got to watch this massive regulatory overhang like a hawk until we get the finalized norms.
Let's zoom out for a second and see how this ties into the global picture. Over on the macro front, crude oil is flashing bright red on the terminals again. Brent crude rebounded right back above $83 a barrel, hitting an intraday high of $83.50. This surge is directly tied to renewed geopolitical tensions around the Strait of Hormuz, which instantly reignites those supply fears. And for India, that's an immediate, tangible headwind. Firmer crude directly pressures our oil marketing companies, hits the aviation stocks, and obviously inflates the national import bill. Throw in the fact that the rupee is somewhat on the back foot, near 95.3 to the dollar, and imported inflation is suddenly right back in the spotlight for your portfolio.
Shifting gears from the macro to the micro, let's break down today's top movers in the futures and option space. Starting with the green, MOTHERSON was our top F&O gainer. It extended its really impressive post-Q1 pop, jumping nearly 8.7% today. The driver there, a sweet EBITDA margin expansion of about 65 basis points. AUROPHARMA also caught a massive bid after reporting a 25% jump in its consolidated Q1 profit. But listen, the market takes absolutely zero prisoners when you miss on volume. Outside the NBFC bloodbath, CROMPTON got absolutely punished, dropping 7.4%. Even though their Q1 revenue was technically up, a nasty supply chain disruption cost them roughly 200 crore in primary sales. The market zeroed in on that volume miss like a laser, and the stock is now sitting a full 25% below its 52-week high. Ouch.
We've also had to digest a massive wall of Q1 results over the last 48 hours. Among the heavy hitters, the clear standout, the one that really anchored the whole domestic earnings narrative, was SBI. State Bank of India printed a remarkably strong set of numbers. That directly fed into the PSU banking strength we talked about earlier, lifting the stock roughly 4%. We also chew through numbers from Titan, Hindalco, and Godrich Consumer Products. So honestly, outside of specific supply chain misses like CROMPTON, this domestic earnings season is painting a pretty resilient picture for India Inc. Moving over to the Whisper Network, the burning question flashing across Reddit's Indian street bets and echoing across all the institutional trading floors today is this. Is the RBI's flexi loan crackdown eventually going to infect the credit card space? Look, when regulators start putting unsecured revolving credit under a microscope, paranoia naturally spreads to the next closest asset class. The market is essentially trying to price in the unpriceable right now, wondering if the RBI is just getting warmed up.
Let's break down the actual scuttlebutt here and assign some real probabilities so we can cut through the noise. For SBI cards, the fear of this rule extending to them is totally real, but credit cards do fall under an entirely different regulatory framework than NBFC flexi loans. So objectively, we're rating this rumor as a medium probability. But if it does hit, you're looking at a potential negative 5 to 10% impact on card issuers. On the flip side, there's heavy chatter that the initial RBI draft on BAJFINANCE might actually get diluted. Industry pushback on these consultation drafts is super common. If the final norms soften, we'd assign a medium probability to a relief bounce of around 3 to 6% from these highly oversold levels. Finally, that old Vedante demerger and deleveraging chatter is popping up again on Value Picker. We rate that as a low to medium probability, mostly because it's a long-running theme and there wasn't a fresh trigger for it today. Prepping your playbook for tomorrow, we've got to look at the exact battlegrounds where the options writers are drawing their lines in the sand. Max pain for the Nifty sits perfectly clean at the whole number of 24,600. You've got your highest put option support base down at 24,000 and heavy call resistance capping things right at 24,600. Now for the Bank Nifty, it is remarkably consolidated. Max pain sits exactly at 58,000, and this is actually pretty unusual. Both the highest open interest for call resistance and put support are stacked right at that exact 58,000 level. So expect some fierce, heavy volume trench warfare around those exact integers right from the morning bell.
All right, the most crucial thing for a trader is knowing exactly what's coming down the pike. Keep your eyes locked on Tuesday the 11th. Remember the new NSE rules? The weekly Nifty options expiry is now on Tuesday, not Thursday. That is definitely going to catch some legacy algorithmic traders completely off guard if they haven't updated their calendars. That Tuesday expiry lands right alongside the final stragglers of Q1 earnings, including some crucial provisional numbers from NMDC and SAIL. Looking a bit further out, we've got HAL reporting on the 13th, and the big monthly index and stock futures expiry landing on Tuesday the 25th. Write these down. These are your definitive market catalysts for the coming weeks. Based on today's tape, your specific setup and idea in focus for tomorrow is a long look at Hindalco. Here is the logic. Step 1. Track the catalyst. Hindalco rode the base metals leadership today, popping 3.2% on firm aluminum prices on the LME and a very solid Q1 print that hit the tape today. So the momentum is clearly there. But step 2 is where you survive in this game. Manage the risk. This trade is highly sensitive to the global macro tape. You absolutely must strictly size your position and manage the risk of any sudden rollover in Chinese demand or a sharp reversal on the London Metal Exchange. It is a fantastic technical setup, but it demands tight risk management. Now, as always, let me be crystal clear before we wrap this up. This explainer is pure market intelligence and my own personal research, designed strictly for educational purposes. It is absolutely not investment advice. I'm here mapping out the data and the logic, but you are the one pressing the buy and sell buttons. So do your own homework, consult with a registered financial advisor, and run your own math before you deploy a single rupee into the live markets. And that brings us to the end of today's tape. With regulatory crosshairs shifting and global tension simmering, the big question isn't whether the market will break its weekly winning streak, but rather which over-leveraged sector will be the very first to crack under the pressure. Something to think about before tomorrow's open. Listen, stop scrolling the noise and get the signal. You genuinely do not need to waste hours of your evening watching screaming talking heads on other financial news channels or endlessly scrolling through bloated, ad-filled websites. You have this single, razor-sharp, purely data-driven explainer waiting for you every single day at the close. So do your portfolio a favor, hit that subscribe button, smash the bell icon right now so you never miss an update, and I will see you right back here tomorrow with the charts queued up right after the closing bell.